posting these up hopefully by the next day or so, in case you want to review any of the material. What we are going to have as a goal tonight is to complete chapter 1. We had left off at module 7, dealing with the entire chapter was dealing with the audit reports, really. I mean, we had some basic things talking about the auditing standards and what the objective of the audit is, but the bulk of the information, the solid 10, 15 point area, was dealing with the audit report. So remember, we had that chart that I kind of called the grapefruit, where we had the unmodified, if we're talking about a non-public company, unqualified, if we're talking about a public company, opinion, that was the best situation. And then we really spent most of our time talking about, well, what happens if we have a gap problem or a gas problem? Gap problem, we consider the opinion to be qualified. And if things go from bad to worse, become more pervasive, then we have an adverse opinion. On the gas side, where we're not able to comply with the general accepted auditing standards entirely, we could go from qualified, we use the same word for not as pervasive problems for both the gap and the gas problems, down to, and we use a different word, disclaimer of opinion, if our gas problems become more pervasive. So we spent quite a bit of time with that, really, and then saw that the approach was going to be to memorize the unmodified, unqualified opinion, and then understand how we change the structure of the unqualified opinion, unmodified opinion, if we have to start going to qualifications adverse. Okay, so hopefully you were able to get into the first 6 modules of homework, looking at how that material is going to be tested, working through multiple choice questions in your Becker software, working through some of the task-based simulation examples that are there. I have not yet begun to get into the Becker Navigator and see how you're progressing toward your homework, but don't forget, the expectation is that you should be completing the modules for whatever we had talked about on our Thursday session, with the goal of getting those materially done by the next time we meet. I'm not going to sit here and hammer you if you have a couple of undone things, but you should be really trying to move towards that pace so that you're hitting your goals as you go to sit for your exam. Okay, so that is a quick review of what we talked about last time. Let's go ahead and let's take a look at the information here now for the emphasis of matter. And really, they talk about emphasis of matter here, but it could also be an other matters paragraph. So we have emphasis of matter, we have other matters. We're going to be understanding the difference between these two. And then we're also going to be taking a look at how the report will be changed as a result of emphasis of matter or other matter. Now, it's worth noting that an auditor could add an emphasis of matter, an other matter paragraph, while the opinion continues to be unmodified, unqualified. So we're going to want to understand under what conditions would we still have to add an emphasis of matter, other matter paragraph, even though the opinion is unmodified, and then understand how that's going to change the structure of the unmodified, unqualified opinion that we have memorized, right? And see where we would need to put that in. So let's go ahead and let's take a look, and we're going to start with emphasis of matter here, okay? And we're going to begin the discussion as we saw last time. Unfortunately, can express some annoyance with the idea that why can't the PCAOB and the AICPA just get together and agree on the structure of the report? For some reason, they seem to think that there's a need for differences. I don't necessarily agree. And so for that reason, we have to separate our discussion out as to what we would say for a non-public company, non-issuer, versus a public company, which we call issuers. Okay, so let's take a look first for non-issuers. And they tell us that an emphasis of matter paragraph is required, could be required by GAS or at the auditor's discretion if they believe there is a need for an emphasis of matter paragraph. The emphasis of matter is used when referring to a matter that is appropriately presented or disclosed in the financial statements. So what's happening? The entity has properly disclosed something in the financial statements, but the auditor makes a determination that they should also mention that in the audit report, and we're going to see point to the location in the financial statements where that is. Remember, the financial statements are the responsibility of management, so they are to determine how to disclose, to account for different things, and the auditor then comes in and looks and see that they have done that. So management does that, they disclose something properly, but the auditor has determined either by requirement or by judgment that that particular item should also be called out in the audit report and point to where it is in the financial statements. Okay, so the auditor, either by determination through GAS or through their own judgment, has determined that it is such significance that it should be included in the financial statements. And note that inclusion of this matter does not necessarily affect the auditor's opinion. In other words, we're emphasizing this matter that's properly disclosed. That means we're not going to qualify, we're not going to adverse our opinion because it's properly disclosed, but we have determined that we should call it out in our otherwise unmodified, unqualified opinion. Now, you flashcard that, and then it makes you think, oh, so the minute we see an emphasis of matter, that means the opinion is not qualified. No, it does not mean that. We could qualify and also have to call out an emphasis of matter. What we're saying here with what I've actually flashcard is the inclusion of the emphasis of matter does not automatically result in the opinion being qualified. Okay, now you come over and let's see what the report requirements are. And they tell us that an emphasis of matter needs to be included, and this is the requirement, it needs to be included. And they start out telling us some things about what we have to is more of a display, more of a structure thing. Use the heading emphasis of matter, okay? Describe the matter being emphasized and indicate, if indeed, indicate that the matter that is being emphasized is not the reason for a qualification, or we may be saying the opinion is not qualified at all. Okay. Now, when are we required? When does GAS tell us you must include an emphasis of matter? Okay. By the way, it's worth noting here because I think probably, you know, you're thinking, well, where am I supposed to put this emphasis of matter paragraph? I have an unmodified opinion, and I'm having to add an emphasis of matter either because GAS told me to or because my judgment determines that I should. Where in the unmodified report in this example should I put it? And the standards don't tell us. The auditing standards do not tell us, hey, you must place the emphasis of matter in this particular part of the audit report. Generally, it comes right after the opinion paragraph. So we write our opinion paragraph, which comes at the beginning of the report, and generally they stick that emphasis of matter paragraph right after the opinion. But for non-public companies, the auditing standards, wherever that's located, AUC, the clarified standards, right? The reporting issues come in the 700s category. So AUC 706 doesn't call out placement. In fact, they say, we're not telling you where to place it, but generally it goes after the opinion paragraph. So if you're being asked to, you know, somehow present a emphasis of matter in some sort of, you know, test-based simulation or something, you would be safe putting it just after the opinion paragraph, because the standards don't call out where exactly it should be located. Okay, now let's go ahead and let's take a look at when the emphasis of matter paragraph is required. And we say if there is a justified, okay, change in accounting principle. Okay, now the reason I underscore the word justified is we're going to look a little bit later here, and we're going to see that in order for an entity to be justified in changing their accounting principles, they're going to have to meet certain requirements. And if they don't, then we would have to issue what? A qualified opinion. okay, or maybe adverse if the problem is more pervasive, because if they aren't justified in making a change in accounting principle, that's a gap problem, okay? But assuming they are justified, they justified changing from, say, completed contract method to percentage of completion for accounting for their long-term construction contracts. Well, we would be required under US GAS to include an emphasis of matter paragraph that says, hey, they were justified, they did it correctly, we're giving an unmodified opinion, as you've seen in the opinion paragraph, but you should be aware, as discussed in footnote X, that the entity has changed from construction contract accounting from completed contract to percentage of completion, and that would be called out in the audit report under the heading emphasis of matter. We're required to do that if that happens, okay? Also, we have a change in the reporting entity, okay? What does that mean? Change in accounting entity, reporting entity is, and we talk about it more in the FAR, but let's say I had companies A, B, and C that I included in a consolidation in year one, and then in year two, I decided that I would include companies A, B, C, and D under a common ownership. Or maybe I didn't prepare consolidated statements in a previous year, and now this year I am. I would be required to go back to the previous year and restate those statements as though, or not as though, having consolidated last year's information into last year's reporting for that single entity or a different set of entities, so that they would be comparable to this year where I have included all entities under common ownership. That's the accounting issue. The auditing issue is to understand that if that happens, I have to include the emphasis of matter paragraph or section in my auditor's opinion that would call out that there's been this change. If there is a subsequently discovered fact that leads to a change in my opinion, then I would have to give either an emphasis of matter if it is properly disclosed, or if it isn't properly disclosed, or if it is not disclosed in the financial statements, I should take the word properly out of there because it's not properly disclosed, and that requires a qualification. If it is disclosed, emphasis of matter. If it isn't disclosed, then a other matters paragraph, which are for things that aren't necessarily disclosed in the financial statements, but the auditor wants to call them out in their report, and that may be required under certain circumstances. Well, it's required that we do this when we have subsequently discovered fact, like we discovered that they should have disclosed something and they go ahead and they disclose it now, but we want to change our audit opinion from, say, qualified to unmodified. We would need to call that out as an emphasis of matter. Then if the financial statements are prepared in accordance with an applicable special framework other than regulatory basis, so sometimes the entity will prepare their statements using cash basis, we're going to have to include an emphasis of matter paragraph for that. There's only one small exception to that, and we will get into that more when we discuss the special purpose financial statements, and that comes on page A194. We're not going to go there now, but just so you can kind of check back if you want to see, well, what the heck is that later, and read back on that. You'll see how that works, okay? So under these conditions, the auditor is required to include the emphasis of matter paragraph, must have the heading emphasis of matter. No question, these things happen, auditor has to include that emphasis of matter, okay? Now, what are some times when the auditor may choose, when it may be necessary? Okay, keyword here is what? May. And at times, the use of emphasis matter is not required, but still may be used at the discretion of the auditor. And I don't really think it's necessary to start flashcarding times in which we can use auditor's judgment for these, because it's an auditor judgment. And I don't see that we need to read through a suggested listing of times when the auditor may decide to do that. Okay. Emphasis of matter required, or auditor's judgment has to have the heading emphasis of matter, does not. necessarily the issue will not qualify the opinion, but it's still included in the unqualified, unmodified opinion, and the standards will tell us where to put it. It typically comes after the opinion paragraph. Okay. Okay, good. Now you come over and we talk about other matters. Now with other matters, it's something that it's something that is not necessarily disclosed in the financial statements. In fact, it's not. That's why we don't call it emphasis of matter. But the auditor either will be, again, required to include the issue or may decide to include it. Okay, so let's just look at the report requirements. And when an other matters paragraph is included, the auditor should use the heading other matters. Okay, and again, they do not necessarily call out the location. Okay, note here though, and they will make this distinction: when the auditor has been engaged to communicate key audit matters, the use of other matters paragraph is not appropriate for a matter identified as a key matter. So if something is a key matter, then as we saw, it has to have the heading like key matter, and it's not considered an other matter if it's a key matter. Okay, and I suspect that the reason we're kind of stating the obvious, right? Well, if it's not a key matter, then how is it? You know, if it's not a key matter, then it's another matter. If it's another matter, it's not a key matter. Why are you saying this to it? Well, apparently there must be some tricky CPA questions where they try to mix those two up. Okay, now when are we required to use other matter paragraph? Okay, and anytime the auditor includes an alert, we're going to flashcard these guys, that restricts the use of the report. And we'll see instances where we're going to be restricting reports later on tonight. If that's the case, we have to put another matters paragraph that restricts the use of the report. Typically, in the stages that we're talking about here, the use of our report is restricted when individuals may be using financial statements and may not be aware of specialized reporting issues associated with this. Then we are often required to restrict the report. And we'll take a look at those towards the back end. As I said, that's about page 90 something when we start getting into that situation. Subsequently discovered fact leads to a change in the auditor's opinion. And again, it depends on whether that is something that has been disclosed in the financial statements. If it has, then we would use emphasis of matter. If it hasn't been disclosed, then we would use other matters paragraph. And that's the real only distinction between those subsequent discovered fact issues. The financial statements of the prior period were audited by a predecessor auditor. We're going to talk about that here in a little while, but just to explain what a predecessor auditor is, let's say you audit the client in 2022, and then I come along in 2023 and they decide to hire me. Well, when I issue my report for 2023, assuming those statements were comparative, I would have to call out that there was another auditor involved. In some cases, I'll call that out, that there was another auditor involved in the 2022 statements. And if I call that out in my report, I would use a other matters paragraph to communicate that. And we'll talk more about that here coming up, but flashcard now that would be required. The current period financial statements are audited and presented in comparative form with complied or reviewed statements, or in comparative format with statements that weren't compiled, reviewed, or audited. So what happens? I audit the current year statements, 2022, we'll say. But let's say 2021, the statements were only compiled. Now, we're not going to talk about this until A6, but a compiled set of financial statements has no assurance associated with them. So I would be required in other matters paragraph for my 2022 report to tell you, hey, look out. Those 2021 statements were compiled. There's no level of assurance on those statements. They weren't reviewed. They weren't audited. They were simply compiled. And I would need to say that in my now 2022 report. An example I'm using when I write up an opinion on that, I have to include another matters paragraph that tells you the previous year statements that you're trying to maybe compare to the audit statements. There's no assurance on those, and I would need to say that. And then to restrict the use of the auditor's report, there are some cases where I am going to be required to include the restriction in that other matters paragraph, and to report on compliance is included in the auditor's report on the financial statements. That's pretty rare, but we'll get to that a little bit later towards the back of the chapters here. Chapter 6, I think we finally get to that. Okay. Now, flashcard these requirements as to when we are going to be needing to restrict the reports, etc. When we have to use, I shouldn't say restrict reports, but when we're going to be required to include the other matters paragraph. They say that there are times that it may be necessary to provide the other matters paragraph. Let's go ahead and flashcard these because these are a little bit weird. To describe a reason why the auditor cannot withdraw from an engagement, or when law or regulation generally accepted practice require or permit the auditor to provide further explanation of the auditor's responsibilities. These are kind of rare things, but let's flashcard those. To explain the first one there, because that might seem a little strange. And the example I would give is, let's say you're looking at the consolidated financial statements of the federal government, or you're looking at, say, the state of California's financial statements. In the state, in the case of the consolidated financial statements of the federal government, it is written into legislation that the Government Accountability Office, the office I used to work for, GAO, is to audit the consolidated financial statements. It's written in legislation. So GAO can't withdraw from that engagement because the legislation says that they will audit the statements. In this case, in the state of California, it's the, I want to say it's the state, it's either the state auditor general or the state controller. I think it's the state controller's office. I don't know if anyone knows, let me know. But the state controller's office, I think it is required by legislation to audit the consolidated financial statements of the state of California. So they can't withdraw. And you don't have to want to include a other matters paragraph that lets users of the financial statements know that you're not allowed to withdraw from the engagement. I think that you would probably be including that in the scenario where you were thinking about withdrawing but weren't able to by legislation. Okay, now that's the conditions for the other matters, emphasis of matter for non-issuers, for non-public companies. For issuers, public companies, they don't call the paragraph other matters. They don't call it emphasis of matter. They call it out as an explanatory paragraph. Okay, and let's go ahead and start to take a look at how that's going to. Remember, we memorized the unqualified opinion. If we're talking about issuers, unqualified opinion, we memorized that, but now we're going to see, well, what happens if I have one of these required explanatory paragraph things. But let's just go ahead and take a look. An explanatory paragraph is included in the auditor's report when required by PCAOB, or at the auditor's discretion. The inclusion of the explanatory paragraph does not affect the auditor's opinion. In other words, they probably should have said that better, because it affects the opinion and we have to include it in the otherwise unqualified opinion, but it doesn't result in a qualification. Okay. Now, when is what are some of the report requirements? And they tell us that the explanatory paragraph should generally include an appropriate heading. Now, I find this interesting. They say an appropriate heading. Well, what's an appropriate heading? And sometimes the appropriate heading will be, explanatory paragraph. Other times the appropriate heading will be something else. Okay. Actually, it won't necessarily be explanatory paragraph. There are times when no title will be required. Other times there will be a title required. The paragraph should describe the matter emphasized and located in the relevant disclosures about the matter in the financial statement. So flashcard that, okay? And notice here, they do in the PCAOB standards indicate to us that it generally will follow the opinion paragraph. Okay. Now, when is the use of the explanatory paragraph required? Let's take a look at that. And if there's a substantial doubt of the entity's ability to continue as a going concern, we're going to be looking at going concern consideration in a later chapter, but we are required both under public and non-public companies to see if we think the company will have potentially go out of business in the next year. For example, we look at their statement of cash flows and we see that they're not generating any cash flow from operations. Well, that's not a very sustainable period of time, right? And so that may lead us to a conclusion that there's an inability of the entity to continue as a going concern. We would be required for a public company to include that in the opinion paragraph as an explanatory paragraph that generally would come after the opinion. They may follow GAAP. I mean, going out of business is not a violation of GAAP, but we would still have to include this explanatory paragraph about the going concern. There's been a material change in accounting principles, okay, just like we saw for the non-public company, a change in reporting entity. There has been a change in investee's year end. A material misstatement in previous issued financial statements has been corrected. Okay, we're probably preparing comparative financial statements or something corrected in the prior period. We would call that out as an explanatory paragraph. Other information in a document containing the audit financial statements is materially inconsistent with information preparing in the financial statements. What the heck does that mean? Okay, well, just picture this. Let's say this is the company's annual report. Well, inside the annual report is a presentation of the financial statements. The auditor's opinion, and I think we looked a little bit at Apple last time, the auditor's opinion covers the financial statements. It doesn't cover the annual report. There may even be a requirement that there be supplementary information. Okay, there may be supplementary information that is really outside of the financial statements. Well, our opinion covers the financial statements. What we're going to see is the auditor has a requirement. We'll get into this. In fact, you can even put C, page 88, 1.22. Okay, the way Becker does their outlines. Okay, and I think it's 1.2.2. And when you get to there, when we get to there, I'm going to show you this again. But basically, what they're saying is, let's say you have a requirement to read the other information. Say the management discussion and analysis is included in the annual report. And they're saying that they had revenue growing at the amount of 500 million per year. And you look and you're like, well, I audited the financial statements and that's not correct. That's materially inconsistent with what I know to be the facts based on the audit of the financial statements. What do? Public company, add an explanatory paragraph that says, hey, statements made in that MD&A are not consistent with what in the financial statements. There's a material inconsistency there. Okay. Now, in that situation, the way I just described that, you would be determining that the financial statements were correct and what the annual report was wrong. Okay. What would you do? This is a question to the group here. What would you do if you thought, oh no, the annual report is correct, the MD&A is correct, it's the financial statements that are wrong?
Probably reach out to the board and tell them that you need to do additional procedures.
Well, you determine that the financial statements are wrong. Let's just leave it at that. And we're talking about the effect on the audit report.
Oh, adverse opinion or qualified opinion?
Good. Qualified or adverse opinion. Excellent, Donald. Yeah, qualified or adverse, right? We need to, okay, well, it looked like the annual report was right and these financial statements are wrong. That's probably not the case because you've already audited the financial statements. You're ready to give the opinion on those unqualified, since we're talking about public company. And then you read the annual report and find that, you know, reading the annual report to discover problems with the financial statements is not the way to go. Okay, that's not how this is supposed to work. So generally it would go the other way. If it were to happen, it's probably a rare occurrence anyway. But coming over and selected quarterly data has been omitted and has not been reviewed. That would be a requirement. Supplementary information required by the framework like GAAP has been omitted, okay, or the presentation of the information is departs materially from the applicable framework, then you would need to call that out in your opinion. So here they're talking about what? This information, right? So again, our opinion does not extend beyond the financial statements, but we start seeing problems, it will affect our opinion on the financial statements with this explanatory paragraph, okay? Now you come over and they tell us that we don't have to have a heading, but we still would have to put up the explanatory paragraph if the prior year report is not presented, prior year opinion is updated, management is required to report on the company's internal controls over financial reporting, but has not, such report has not been audited. Then we would need to include that as an explanatory paragraph, but it doesn't have to have an appropriate heading. You just be sitting there with no heading on it, essentially. Okay, now look, guys, this is annoying. I understand that you have to make this monstrous flashcard that has all these things on here. You know, I find it unfortunate that the CPA exam asks questions about, in my opinion, are unusual circumstances that these kinds of things would start happening. I mean, I think, you know, probably the more, you know, common thing would be, you know, right here, there's been a change in accounting principle or maybe change in accounting entity. You know, yeah, those things happen, right, in regular business operations. These other things are like kind of, in my opinion, people smoking crack, not doing what they're supposed to be doing, you know, and we have to start including the explanatory paragraph. But the CPA exam, even though it's a professional exam, is to a large extent an academic exercise. And so all these other things do come into play. So you're gonna have to flashcard all that. Okay, question? Okay, good. Then use may be necessary, what, at the auditor's discretion. Okay, again. Okay, and if that's the case, you should use an appropriate heading for that.
Professor, I have a question.
Yeah.
When it comes to organizing the content on your flashcards, I mean, I've been doing flashcarding all weekend and I'm finding I am just running out of flashcards. So is there a
Running out of
particular-
pieces of paper to make?
Well, I need to buy more, of course.
Yeah.
But
What do you
when
mean
you
you're
have,
running out of flashcards? Yeah.
but when you have points like this one, you have on a screen with like 12 or 14 bullet points. Is there a particular more efficient way to flashcard the content, or just only
That I can think of.
only like write the content that you highlight in yellow? Or
Well, you don't have to put, okay, yeah, that's a fair question. You don't have to put the stuff exactly as it's stated here. In fact, you know, you can use some creativity to say, well, how will I articulate this particular point that John has asked me to flashcard? And if you can come with some abbreviated language that works for you to remember what it is that you're supposed to put, then that's encouraged, But in terms of, is there some way to not include some of this information, or can I somehow prioritize not versus, one point versus another? That I don't really have. If I've asked you a flashcard, it's because I've seen some questions they're going to ask that. If you start to run out of space on one card, because I've suggested the 3x5 cards, then, you could say, continued on to the next card or something, so you'd probably put nothing on the blank side for the second card, and then the rest of the answer would continue on the next. Maybe, this might be 3 cards. So it's a lot of writing. It's not a particularly efficient process. It feels very cumbersome, I guess is the word I'm looking for. Nobody, that is, right now there's this 14-year-old kid somewhere riding a skateboard that someday is going to end up having to sit here and write up a bunch of flashcards for the CPA exam. Okay, so it's not something somebody dreams about in their childhood. Oh, I can't wait to do this. But it is something that when you get to the final review stage, these flashcards are going to become a very important vehicle, lifeboat for you to get to your goal of passing the exam. And I wish I had saved or knew. I think I saved them for a while. I don't know where they are now. They're probably in a dumpster somewhere. I should have saved them. When I was making the flashcards, I had like this for my FAR flashcards. I need to get on the screen here. You need to zoom out, please. But it was like this, okay? And I remember I was a housekeeper in the hospital. I was studying for the CPA exam, and I remember somebody sat there, another housekeeper, fellow, colleague, looked at me and go, "What the hell are you doing?" They couldn't believe I had all these flashcards, and it was like, well, I've taken this approach that if I just read the book, I don't feel that I'm really absorbing the material. So what I do when I was studying, what I was doing is when I go through the material, I'm going to make up flashcards. I used to call them documentation of understanding. I got it. I got the concept. I'm going to now use the creative side of my brain to create a flashcard that will help me to remember this. Then, as I talked about in the How to Study guide, I went through the flashcards and memorized all of them before I worked any multiple choice questions. So by the time I got the multiple choice questions, I was ready, and I was getting a good 75–80% when I worked those. Then I put that material aside, go into the next, module, next week's worth of information, whatever. And then I would do the same thing. And then when I got to the final review, 2 weeks before my exam, I would go, okay, I'm going to rework all of the A1 questions. I'm going to rework every single homework question in A1. My exam's in 2 weeks. I've been keeping up with this material as I've gone along. I didn't wait till the end to do the homework. I did all my homework, but then I'm going to redo all of it. And what I did was I would go through the flashcards for A1, then I would rework the A1 material, A2, A3, and so on. And I'm here to tell you that, in my opinion, by the time I walked in the exam, I was on fire. There was very little that they could throw at me that could mess me up, except for on the auditing exam, audit sampling. I gave up on understanding audit sampling. 10-point question on audit sampling. So I barely passed auditing. I passed it with a 75 because I didn't do the requisite job of what I needed to with the one thing, audit sampling, that ends up being a big 10-point question on your exam. So you've got to understand everything. And the flashcards help you, but the other part of that story, I'm rambling a little bit and I'll stop here in a minute. The other part of that story, though, is that I saved myself. So in those days, you could take the exam out with you. So I took my exam booklet out with me. And what Becker suggested, Newt Becker himself suggested, the person who started Becker's now teaching CPA review in the big CPA review class in the sky. What Newt Becker told us to do was circle your answer in your test booklet and then record it on and you use the Scantron type bubble sheets thing in those days. So, you know, put it here, then put it there. So that when you took your exam booklet out with you, you knew what you had picked on each one of the questions. So probably less than a week, maybe a week after the exam, Becker would email, snail mail, there was no email in those days, all of the, what they thought to be the answers to all the CPA exam questions. And so you immediately go get your booklet and correct your exam there to see how you did. And I was getting 95% on my multiple choice questions. So I knew, okay, I didn't do well on that audit sampling question, but I think I got a good chance of passing the auditing exam because I was doing 95 on the multiple choice questions. And yeah, it barely got me by. So the story, moral of that story, use the flashcards to really, really know how to quickly come to the answers on these multiple choice questions and how to survive the task-based simulation. That's one moral. The other moral is anything that you don't study will be on your exam. Okay. Does that help a little bit, I hope?
Yes, thank you for sharing.
Yeah, okay. Okay, good, sure. Now you come over and we talk about lack of consistency. Now, as soon as you see the word lack, you think, uh-oh, there's a problem. Well, not necessarily, okay? When we say lack of consistency, the presumption is that the financial statements are consistent. They will use the same accounting standards from period to period. That's the assumption. However, sometimes a company may change the accounting principle they are using. They will go from one acceptable GAAP to another acceptable GAAP. They will go from completed contract to percentage of completion. Why? Because now they have a better way of estimating what stage of completion they are on a construction contract, and they believe that that would be a better, fairer presentation for them to use percentage of completion. They convince their auditors of that. So the auditor is satisfied. So we're not going to modify our opinion at all. We're not going to turn it into a qualification or adverse issue because they've done what they're supposed to do. But as we've seen, the standards tell you under those circumstances, you are to what? Add a emphasis of matter, explanatory paragraph. We're talking about public, non-public emphasis of matter that calls that out. Okay, so that's what we're looking at. And we say that unless the auditor's report explicitly states otherwise, the audit report implies, that means we think it's automatically the case, that the statements are comparable between periods. Okay, now the auditor should evaluate, let's change that up a little bit. The auditor should evaluate whether the comparability of the consistency of financial statements has been affected by a change in accounting principle or by an adjustment to correct a material misstatement in previously issued financial statements. Okay, now what we're going to do is look to see, well, what makes the change acceptable? Because if the change is not acceptable, that's a violation of GAAP. Now we're going to have to qualify. So we first need to determine that. If the change is acceptable, then under what circumstances, what kind of changes will automatically result in the emphasis of matter paragraph, what kind of changes will not necessarily result in the emphasis of matter. That's really the approach. Okay, so first, what makes it acceptable? Okay, and what makes it acceptable, we need to consider, and let's flashcard the newly adopted accounting principles in accordance with the applicable reporting framework, US GAAP. The method of accounting for change is acceptable. Disclosures related to the change are appropriate, and the entity was justified. Justified means they can't come to you and say, we heard if we use percentage of completion, that'll increase our net income. Is that true? Because if it is, we want to do it. That is not a justification for the change. It's got to be, hey, we have better estimating techniques, and we think this would improve the reliability of our financial reporting. That's the kind of discussion that would lead to, the change being acceptable. Okay, one second, let me do something here. Okay, and generally, guys, I ask you to mute and then just unmute. Please feel free to unmute whenever you're ready, just to avoid some ambient noise, because when I hear noise, I think somebody's going to talk and it just gets a little distracting. But please feel free to unmute with any question, even if I mute you. Okay, now, if the auditor is satisfied that all 4 criteria are met, the auditor would include an emphasis of matter, non-public company, explanatory paragraph, public company in the auditor's report. If the criteria are not met, then we will have to do what? We will have to modify the opinion accordingly. In other words, we will do what? Be heading towards gap qualification or adverse opinion. Okay. Okay, good. Now we come over and we give examples of circumstances that would require the emphasis of matter explanatory paragraph calling out the change. Okay, change in accounting estimate that is inseparable from a change in accounting principle. What the heck does that mean? They say depreciation method. Okay, what is it? Let's say an entity is using declining balance depreciation, say double declining balance depreciation. When a company uses double declining balance depreciation, what they're saying to you, if you look at the mathematics of declining balance, they're saying to you that this asset depreciates what? Quickly in its early years and slower in its later years. As the balance declines, the amount of depreciation goes down. And let's say they do that for 3 years of an asset that they're going to be using for 5 years. In the last 2 years, they say, well, now we're switching to straight line. Well, if that's the case, they're telling you that they think the asset does what? The asset depreciates evenly over its life. Is that a change in estimate or a change in method? Well, the accounting standards say it's a change in estimate. And since it's a change in estimate, you don't have to go through all the requirements for reporting a change in accounting principle by doing a cumulative effect adjustment to the beginning retained earnings of the earliest period presented. You don't have to do all that for a change in accounting estimate that's inseparable from a change in accounting principle. You've gone through the FAR information, you know that, right? For the auditing standards, they're saying we don't give a shit, okay? You will still modify the auditor's opinion by adding the emphasis of matter explanatory paragraph for a situation like that, even though US GAAP doesn't consider it a change in accounting principle. Correction in an error. Okay, maybe we made an error. We have to correct that. The entity made an error and they have corrected that. We have to add. Now, when we say corrected it in previously issued financial statements, if the entity makes an error this year and they fix it this year, then that doesn't affect the auditor's report. If they made an error in a previous year and they're corrected it, we already issued the statements and now they're correcting that. And we're doing what? We're saying, well, here's our opinion on the current year statements, unqualified, unmodified, but you should know that they screwed up last year and they have fixed that now. Okay, well, that would require the explanatory paragraph, the emphasis of matter, a change in reporting entity. Okay. Correction of a material misstatement in previously issued financial statements, which is pretty much the same thing, correction and error in accounting principle. Correction of material misstatement, maybe it's not a problem with the accounting principle, but they still have to correct something, right? Okay, and those both have the word correction there. Okay, coming over, an entity's financial statements include a significant investment using the equity method. the auditor should evaluate the consistency and should include consideration of the investee. Okay. Now we come over and you can go ahead and flashcard that other matters in accounting estimates, okay, or errors do not affect the consistency standard and do not affect the auditor's report. Now you look at that and you're saying, well, what do we mean other estimates, okay? Other accounting estimates. Let's go back to depreciation. Let's say I don't change my method of depreciation. I change my estimate as to the useful life of an asset. So I have an asset that I'm depreciating over 10 years using straight line, and I depreciated for the first 3 years. In year 3, I decide, you know what? This asset doesn't have a 10-year life. It actually has a 5-year life. Well, what would I do? I would take the remaining book balance, okay, and I would depreciate that over the remaining 2 years. Well, that's a change in accounting estimate. That does not require the explanatory emphasis of matter paragraph, because it was just a change in the estimate of how long the asset would last, not a change in the depreciation method. Okay. Now you come over and if the change in accounting principle is immaterial, no revision of the report is necessary. Look, guys, you could pretty much say that about anything. Anything that is not material generally does not result in a qualification or a modification of any sort, I should say, in our report. The one exception to that is if there is an immaterial fact that it has impaired your independence, then what? Not only does it affect your audit report, you really should be withdrawing from that engagement. So it could be you own $1 worth of stock in a company. Well, since a direct investment in an auditee is not allowed, not only does that, and you say $1, that's immaterial, does not matter. Independence is the one area where independence does not. Independence is the one area where materiality does not matter. Okay. Okay, good. They give us a summary, but I think we flashcarded the key effects there, things that we want to understand. And we can go ahead and take a look at a couple of multiple choice questions. Okay, there we go. Okay, we're coming up on 2 minutes and most of us have had a chance to respond to this. And so let's take a look. Okay, the largest percentage is for the correct answer here. So that's good. And when I combine that with the folks that chose C, I think we're on the right track. Nobody wanted A and a few folks wanted B. So let's just go ahead though, and let's take a look. And I'm going to go ahead and remove the poll here so we can see what we're doing on the screen. And let's just look at some key words here. It says management of a non-issuer believes and the auditor is satisfied. Now, let me ask you a question. If management believes and the auditor is satisfied, do you think we're going to have a happy ending to this story or a sad ending? That's
Happy.
Happy.
We're going to happy, aren't we? The auditor is satisfied. Remember, the auditor was what? Sad when we had what? Qualified opinions. So A and B, I can almost take out just from reading the emotions that are being articulated or feelings there that are being articulated here, okay? But the satisfaction is that a material loss probably occur when pending litigation is resolved, but management is unable to provide a reasonable estimate of the range of potential loss. Well, what happens under US GAAP when that's the case? They simply would have to disclose the matter. I mean, we can't force them to come up with an estimate. They're saying, and by the way, they can't be laying down, on a couch drinking, some bourbon saying, hey, sorry, I didn't have a chance to figure it out or anything. They have to demonstrate to the auditor, there's no way that we can reasonably come up with a range, and we don't want to mislead users by coming up with some sort of bogus range. And they fully disclose the situation. Well, what else are they going to do? Okay, so management can't make the accrual. They can't even come up with a range, let alone make the accrual. The accrual would be that they think it's probable, and they have what? The ability to come up with a exact amount. Then they would make an accrual. They can't even come up with a range to be able to make an accrual. Or if they do come up with a range, they have to at least book the lowest amount, but they couldn't even come up with a range. So they can't make the accrual. Okay, and since it probably will occur, then they should accrue that because it would be probable in that situation. But if you can't even come up with a range, then you can't even book anything. You can't book that lower end. So what happens? You give them an unmodified opinion. The situation is fully disclosed. So it's not an other matters paragraph. It's what? It's an emphasis of matter. Okay, so even though they didn't call out emphasis of matter, it's still what? An unmodified opinion, making D correct. Question. Okay, good. Let's look at question 2. Okay, good. We're ahead of schedule here. It's more than 2 minutes. It's less than 2 minutes, but I'm going to go ahead and put the answer because it looks like everyone's had a chance to try this one. And okay, we're at 75% here. I would think that this one should be heading more towards 100% accuracy, but let's just go ahead and take a look to see, you know, how we would have reasoned our way through this question. So you take a look, the answer here is C. Okay, most of us got it right. Okay, but let's take a look. For which of the following events would an auditor issue a report that omits any reference to consistency? There'll be no discussion about consistency, neither in a emphasis of matter, other explanatory matters paragraph. There'll be no mention of consistency, or in a qualification, which is going to, the qualification, remember, we have to give what? The reasons for our qualification, okay? So what situation is that? Well, we look at D, management's lack of reasonable justification for change in accounting principle. Are they supposed to be justified? Series of questions here, guys. Go ahead and unmute. Management lack for reasonable justification. Are they to be justified when they change an accounting principle?
Yes.
Yes, they are. Good. If they are not justified, what do we do?
Qualify our opinion.
Qualify our opinion. Good. If we qualify our opinion, what do we do? How do we do it? When you qualify your opinion, how do you do it? That was our part one of our discussion from last time. When you qualify an opinion, how do you qualify an opinion?
Be step 4.
Good. We go ahead and we would put in our opinion except for, and then if we're dealing with the non-public company, there would be reasons for our qualified opinion. And our reasons would be they lacked a justification for a change. In other words, they were not consistent, right? So no, we would qualify the opinion, and in our reasons for qualification, or in our explanatory paragraph, giving why we had qualified, if we're talking about a non-public company, then, a public company in that situation, then we would talk about this, right? Okay. How about change in accounting for the method of inventories? Assuming they are justified for the change, we would do what? We would include the emphasis of matter paragraph that says, hey, they changed from one accounting principle to another, which is a discussion of consistency, isn't it? The word change is the opposite of what? Consistent. Something that's consistent, right? B, a change from accounting principle that is not generally accepted to one that is. So maybe last year they were using the inappropriate accounting standard. They weren't doing it correctly or whatever. They changed, and what we're saying, hey, this year they're using the correct accounting method. Last year, though, they weren't, and we would have to call that out as an emphasis of matter in the current year's reporting. Okay, change in the useful life used to calculate the provision for depreciation. Yeah, that was exactly what we talked about. Useful life, if you were depreciating something over 10 years, and now you're saying, hey, it only actually has 5-year life, that changes the estimate. There does not need to be anything mentioned in the auditor's report for that. The reason being, by the way, guys, if every time we had to modify our audit report for a change in accounting estimate, we'd probably be doing what? Providing an emphasis of matter every single year. Well, that's not something that you want to be in. You want to do this when something has happened that doesn't happen all the time. So for a change in the useful life, change in accounting estimate, you don't have to mention that, unless it is a change in accounting estimate that is indistinguishable from a change in accounting principle, for example, the method of depreciation, but not the useful life. So the key word there was the useful life. Okay, question? Okay, good. Let's take a look now. And what we're going to do here now for this module 8, as we go through, we are going to start to see now some of the things that we have already talked about. I'm just taking a look. Yeah, we're going to go ahead and continue on here. I was thinking maybe we would get through this next module before the break, but no, we'll take the break here in a little while, and we'll still be in the middle of this module. But anyway, what we're going to see is some of the things that we saw are reasons to add the emphasis of matter. Some of the reasons we've seen to add the other matters, some of the reasons we've seen for public companies to add the explanatory paragraph are going to be fleshed out a little bit more here. So we're going to talk about the nature of these things, and then again, we'll sort of show you in more detail how it will affect, and in most of the cases, we're talking about how it's going to affect the unmodified, unqualified report. Okay, so let's just go ahead and take a look, and we talk about when comparative financial statements are presented. Let's just stop right there and make sure we understand what comparative financial statements are. So what happens? We're doing the 2023 audit, and the entity will prepare, often they do that in columnar format, the 2022 statements. So there'll be what? The balance sheet for both years, income statement for both years, statement of cash flows for both years, statement of stockholders' equity for both years. Okay, and it allows the users of financial statements to compare, they call a longitudinal year-over-year analysis often. Okay, now we go ahead and we are to express the opinion, and we are going to, in our audit report, refer to each period for which the financial statements are presented and on which an audit opinion was expressed. Okay, now because the report date for the most recent financial statements is used, the auditor should update the audit report on the financial statements previously issued. Now, update means reaffirm, or it could change our original opinion. Okay, update means, yeah, I said it was qualified last year. I said it was unqualified, unmodified last year, and I still believe that. Okay, you don't have to say that in the report. It just means that you're going to write your report, and you're going to call it the 2 years, and you'll unqualify, unmodify for both years. Or it could mean that, now I believe my statement from last year should have been modified because there's been some new information that has come to my attention. Okay, now what happens if we have reports with different opinions? Okay, so what happens? Now we look at 2023, 2022 in comparative format, and let's say I was unqualified for 2022, but for some reason I had to qualify 2023. So everything was fine for 2022, and I have to now qualify 2023. And this can happen, often does, okay, frequently does. It's often, but it does happen. The auditor may express a qualified, adverse, or disclaiming opinion, or include an emphasis of matter, or other explanatory paragraph with respect to one or more financial statements for one or more periods, while expressing a different opinion on the other. Okay, and basically that's what we're talking about here. Okay, so let's just go ahead and I meant to do this. Instead of use 2023 in 2022, what I want to do here is use X1 and XO. XO is not extra old here, it's just the year XO. And then we have X1 is the current year, which is being qualified. Okay, and the reason I use X1 and XO up there, and I meant to do that before, is when you look at the audit report, okay, and we have what? If we're dealing with a non-issuer, okay, we would put the heading instead of our opinion, we would call it what? Qualified opinion, okay? And we mentioned both years, but then when we talk about except for, notice that the except for calls out the problem with what year? X1. The problem was X1, they did something wrong in X1. Except for what they did wrong in X1, you just put the year where the problem was, and then you continue on with the rest of the opinion that, you know, in our opinion, the financial statements are fairly presented, and you call out the 2 years, X1 and XO. So it's a very easy solution, guys. It sounds like a big deal the way we set it up, but all you do is you call out, you modify the report to call out the problem as it relates to the year in which the problem has occurred. Okay, you come over and you take a look at basis for the qualified opinion, and notice when we get into the basis for the qualified opinion here for the non-public company, they're calling out what? X1. The problem is with what? With X1, our qualified opinion X1. The rest of the report is exactly how you memorize. Remember, management's responsibility paragraph is never affected. So again, the approach here is to know the unmodified, unqualified opinion, have that memorized. We've had to qualify one of the 2 years. What do? Call it a qualified opinion, call out the except for, but now isolated to the 1 year representing basis for the qualified opinion, limited to the 1 year that we're calling out the problem for, and the rest of the report is exactly how you memorize. Okay. Now you come over and they keep giving us different examples of what you would do when there's a problem in any 1 year. Again, I'm not going to go through all that because the situation doesn't matter what the situation is. What matters is, do we know how to approach it? Okay, if there's been some qualification for some reason, you call out the qualification as it relates to the year that we are discussing. Okay. Now, we come over and we talk about updating prior opinions. 1 second, guys. Just want to look back at something. Okay. I went a little too far past because I was asking myself, where's the issuer example? Okay, so for the issuer, I will look at that just because the structure of the report is different, but the approach is the same. When we write the opinion now, we write what? In our opinion, except for the effects of, and it would have been nice for them to stick with the same years here. On the X2 statements, and then we call out our problem as it relates to what? As it relates to X2, now in our explanatory paragraph, as opposed to basis for our qualified opinion. Remember, we simply add an explanatory paragraph for we add an important explanatory paragraph for our qualification for a public company now. Okay, so call out, modify the structure of the report, not the structure, keep the same structure, but modify what you put in the report for the qualification as it relates to the year that we're talking about. Okay, now updating, changing prior year's opinion. Okay, what happens? Let me just stop here and let's just sort of use our imagination a little bit to do an imaginary story. Okay, let's say you're auditor, and I come to you and I say, unfortunately, we are going to need to give you a qualified opinion. Okay, you didn't give us some information about some leases that should be capitalized. And we think you should capitalize these leases, but you can't really come up with the information you need to make the correct adjustment to the financial statement. So I say, well, I'm gonna have to qualify, okay? You're the management of that company. You go to the board of directors, and I would have told the board of directors I'm qualifying in the reason. So the board of directors calls you in. Are they happy?
No.
They're not too happy. They're thinking, you know, what's going on here, guys? So they tell you, well, look, get to work and figure out what it is we need to do because we want to fix that problem. So you go and you work real hard. Your staff works real hard. You figure out the problem. You figure out the correct adjustment. And you call me back and say, John, guess what? We fixed the problem. Can you please come and look and see if you're okay? And if you're okay, can you change the qualified opinion to unqualified? Can I do that?
Yes.
Yeah, I'll change it. I'll say, oh, I come and I take a look. You show me the documentation. Good job. I can change my opinion, but I'm going to have to what? Modify that opinion accordingly. When I say modify, I don't mean modify it to qualified. I'm really changing it from what? From qualified to unqualified. But in this example, but I need to do what? I need to write the report in such a manner so someone knows that I had a different opinion and now it has what? And now it has changed, okay? So what we want to do is understand the format, and you know that I'm not the biggest fan of Becker mnemonics, okay, but I do like this one. First, let's take a look. The updated opinion differs from the previous opinion. Auditor should disclose the reasons in an emphasis of matter or explanatory for a non-issuer or explanatory paragraph for an issue. And we have to contain the following in that paragraph. Okay, so let's just go ahead and flashcard. And I do like this mnemonic because I think it's kind of cute because they tell us what? Only dorks change their mind, which of course that's not true. Only dorks refuse to not change their mind when presented with better facts, but whatever. That's the you know, I kind of hesitate to mention something in the news to you guys because then it feels like I'm trying to get political or something, but I almost feel obligated. I don't know if you saw former President Trump being interviewed on one of the networks, Fox Network or something, and he said that the investors and creditors, investors and whatnot, know that the financial statements are wrong and shouldn't be relied upon because we put all this information about management's responsibility and stuff right on top of the financial statements, he said. And I was like, huh? Wait a minute. I know something about this. That's not what the report says. When we start talking about management, and this is why I feel a little bit obligated to mention it to you guys, that's not what that is saying. The management responsibility paragraph is not punting our responsibility to give an opinion on the financial statements, which can be relied upon. So we haven't punted and said, don't rely on these financial statements because we start talking about management responsibility. We just want you to understand who's responsible for what. Our responsibility, I should say, is to provide an opinion. And in our opinion, the financial statements present fairly, meaning that you can rely on them. Now, if he believed that the financial statements can't be relied upon, then there should have been what attached to that an adverse opinion that said they can't be relied upon, which I doubt that was what the case was. Anyway, I'll stop there. Okay, so only dorks, though, changed their mind, okay? And what we would do is we would add the emphasis of matter / explanatory paragraph. And we would add that to the otherwise unmodified, well, which is now an unmodified opinion. We changed our mind. Facts have arisen that have caused us to go from what was before a, say, qualified opinion. Our reasons, they fixed it. The reasons for the prior opinion, they didn't capitalize some leases. The changes, they fixed it, and a statement that now our opinion, instead of being qualified, is now unqualified. An example that we're giving. Okay. Okay, good. Let's stop there because I think timing wise, we're about up to break time. And let's go ahead and let's come back at 6:40. Okay. And let's continue on now here with this discussion of predecessor auditors. Sorry, guys, 1 second. I generally forget after the break I'm able to get a little more light in here, although we're coming to that part of the year where we will probably be in the dark around the time we start the class. Not that kind of dark. Hopefully there's light being shed on the subject matter, but the light in the room will be dark. Okay, let me do what I'm doing. Sorry about that. Okay. All right. It's a little more light here. So let's just have so you don't have this shadow figure talking to you. Okay. All right. So let's go ahead and let's take a look. And again, remember what we're really focusing on is some of the causes of the emphasis of matter explanatory paragraph that we sort of set up the reasons for it earlier, but now we're getting more into detail. Okay. So now we talk about predecessor auditors. Now let's make sure we understand the term predecessor auditor versus successor auditor. So let's say you audited the 2021 statements, and then the client chooses to change to me as the auditor of the 2022 statements. Okay, what would happen in that situation? You would be the predecessor, I would be the successor. Okay, now let's say I came to you and I said, well, look, the client wants to prepare comparative financial statements, and what we would like to do is have your report there right next to my report. So your report would cover 2021, my report would cover 2022 in this scenario. Would you want to do that? That's a question.
Yes.
Okay, well, thank you, Michael, for being a nice guy. I knew I could rely on you. Now, you don't have to, but if you decided to do that, Michael, you might want to get some assurance that maybe something hasn't happened that would cause you to want to what? Change your previously issued opinion, right? And since you're no longer involved in the audit of the 2022 statements, you're going to ask for some things that'll help you with that. Okay, so that's where we're going. Okay, and what happened? The report of the predecessor auditor's report is going to be what? Is going to be presented. Okay, and notice that here they put the onus on the predecessor here, that if you're going to allow your report to be presented, then the predecessor has certain responsibilities. So you will read the statements of the current period and compare them with the statements of the compare the current statements with your statements, the prior year statements that you ought to compare them with the current statements. Okay, now maybe you'll see some unusual spike in one of the line items of the financial statements. You'll say, what's wrong? How did this happen? Was it you're saying your statements are okay? Maybe something's wrong with mine, right? That's the reason that you're doing that. You will also obtain a letter from me, the successor, saying whether anything that I did revealed a matter that would affect your opinion, okay? Because we would kind of be doing that if Michael, if you were still here, you would do that, but now you weren't involved. So you ask the successor, are you aware of anything? And then you ask management if they believe that there was anything that should affect your previously issued opinion. And if you get all of those things, then you can go ahead and either issue the report unrevised because you still think everything's okay, or you may say, oh, okay, well, now I know there was a matter that should have been raised in the previous report, so I'm going to reissue it. Okay, I'm going to revise it, I should say. Okay, so go ahead and flashcard the responsibility of the predecessor. Now, let's say that, Michael says to me, I don't think so. I don't want my report to be put there, okay? Well, then what I could do, okay, I'm the successor now, okay? And when the successor does not present, so now I'm not going to present, okay, it's not reissued, it's not going to be presented, then it is up to the successor to do certain things. So the successor auditor should express an opinion on the current financial statements only and indicate and remember, guys, we were now getting more detail as to what we meant about a predecessor auditor and there being an emphasis of matter or other matters or explanatory paragraph, I should say, public versus non-public company for those two titles. And we will say that the financial statements were audited by a predecessor auditor, okay? Give me a flashcard right here that in that situation, you do not name the predecessor auditor unless you somehow have acquired their practice. Continuing on though, the type of opinion that they expressed, was it modified? Was there a reason for a qualification? Was there an emphasis of matter in that report or explanatory paragraph? And the date of that report. Okay, so flashcard those yellows at a high level thing, and then you can include a separate flashcard that would call out that blue that you don't name them unless you have acquired their practice. Okay, so big picture, it's either going to be presented or not presented. If it's not presented, predecessor got some things they're going to want to get. If it's not presented, then the successor will essentially book report whatever was in the predecessor report in the current year's report. And we just give that approach. Okay, good. Now we come over and we also said, well, what happens if we issue comparative financial statements and they were not audited? Okay. And we say that they could be compiled or reviewed. Okay. So again, let's say 20X1 is audited, but 20XO was only, say, reviewed or compiled. So we've had what? We've had an upgrade in service, haven't we? We've gone from a review or compilation to an audit, okay? So when the current period financial statements are audited and presented with prior period statements that were only what? Review or compiled, okay, then what? Then the auditor should include an other matters paragraph or explanatory paragraph in the auditor's report that will include the following, okay? And let's just go ahead and flashcard this. The service, whatever it was, compilation review, the date of the prior period report, a description if there were material modifications to the report, a statement that the service was less in scope than an audit. Let me stop for a second. When you provide a higher level of service, they will always require you to call out that the prior period did not constitute the level of procedures that would be for that higher level of service. So since the higher level of service here is audit, you have to put that explicit statement in there. We haven't done the auditing stuff for, in this example, the 20XO, and therefore we do not give an opinion. If you do not give an opinion, that's the same as what? a disclaimer of opinion, you're disclaiming an opinion on the XO statements. Okay. Okay, good. Now you come over and sample of that paragraph, and they say, look, we didn't audit the previous year statements, we compiled, we reviewed whatever it was, and therefore we are sitting here and we are not going to express an opinion. That last part is the disclaimer that I mentioned. Okay, now what happens here? If the prior period statements were not audited, compiled, or reviewed, so we have what, 20x1 is audited, 20xo is nothing. There was no involvement with an accountant of any sort. You know, I said accountant, third party, independent accountant, okay? And there's nothing, same sort of thing. You would sit there and you would do what? You'd say, hey, the other statements were not audited, compiled, reviewed, nothing. You don't call out another level of service because nothing was done. Same basic concept. Okay, let's take a look. Well, I'm gonna go ahead and highlight that a little bit better. So the prior period statements were not audited, reviewed, or compiled. You should clearly mark the auditor should include an other matters paragraph or explanatory paragraph that says we didn't audit, we didn't review, we didn't compile. There was no previous period engagement that would have yielded a report. Okay. Okay, good. Come over and let's take a look at a multiple choice question or two for this information. Okay, guys, I've given you a little bit more time with this question because it's kind of a tough question, but don't check out of the process here now. You need to sit there and you need to fight through these questions, okay? Even if you feel uneasy with the information, okay, to be able to answer it, because eventually that's what you're gonna have to do, okay, to pass the CPA exam. So let's go ahead, and we're coming up on 3 minutes. So I'm going to go ahead and end the poll, but let's take a look at this one. And okay, that's a pretty good turnout. correct response, the answer here is A, for what I consider a tough question. So good work, okay? Because when you look at this question, and remember, when you're on the exam, it's not like you were just talking about something that you see a question for, right? So this is a question that, in my opinion, you have to critically read, okay, to really be able to answer it as well as you did. So when reporting on comparative financial statements, an auditor originally should change the previously issued opinion. Okay, now you look at that and you say, change the previously issued opinion from what to what? They don't tell us. Okay, they don't tell us here from what to what. It could be that I'm changing it from qualified to unqualified, unmodified. Could be that it was unmodified, unqualified, and now I'm qualifying it for some reason, right? Okay, so they don't really tell me what direction the pendulum's going here, okay? And so you start to take a look, and the first choice says prior year financial statements are restated to conform with generally accepted accounting principles. Well, that is describing one of the two cases, which is what? I went from apparently qualified when they weren't in conformity to what? Unqualified, modified, because they are in conformity. So A seems like, yeah, it sounds that would describe that situation. Now, I guess technically you could say, well, that means I shouldn't read the rest of these, but remember, you should always read the other choices because you need to, make sure that you haven't missed something, right? So we come over and I look at item B. Auditor is a predecessor auditor has been requested by former client to reissue the previously issued report. Well, that's not going to cause you to change your opinion. That would cause you to what? Ask for certain documents from the successor, from management, do the comparison, all those steps, but it's not going to change your opinion necessarily. They're saying you should change your opinion when what happens? When they've done something to make you change your opinion, which A is describing. C, prior year's opinion was unmodified, and the opinion on the current financial statements is modified due to lack of consistency. Well, they said change on what? The previously issued opinion. Prior year statement was unmodified. Current year statements is modified. So what? I'm not changing anything. I would still have the same opinion on the prior statements, so I didn't have to change anything. Prior year financial statements are restated following a change in reporting entity. Well, that's not going to cause me to what? To change my previously issued opinion. It just means that I'm going to do what? I'm going to add a emphasis of matter to the current year financial statements calling out that change. Okay, so that's a pretty tough question. You did well on it. Make sure you continue though to read those questions as carefully as you did as you're going through your homework, and you will get, as I've mentioned, I'm not so, and I probably should have told you up front, I was going to give you more time on this one. I'm not so worried about the timing at this point, the speed at this point, as I am you're correctly understanding the material. It's kind of like, if you're doing some sort of sporting endeavor and they keep telling you, no, get the form, and then you keep practicing with that correct form, then you get faster and faster as you go along. Okay, good. Let's go ahead and let's take a look at number 2. We're at 2 minutes. I'll give you a little more time. Okay, guys, let's go ahead and wrap up your choices here, and let's take a look at this one. And I would say this is, again, a fairly tough question, but again, good results, okay? 86% of us got it correct. But let's take a look. A couple folks wanted to choose D, and I think I understand why you might want to choose D while you're still kind of trying to solidify your understanding of this stuff, okay? But comparative financial statements include a prior year's statement. They were audited by, and we have a predecessor auditor coming in whose report is not presented. Well, if the report is not presented, the successor is to do what? Is to summarize the results of the predecessor auditor's report, okay? So it says, add an emphasis of matter that expresses only limited assurance concerning the fair. No, that's not what we do. Express an opinion only on the current year and make no reference. What do we call that? The closing our eyes and swinging approach to something. So nobody got fooled by B or C. C, indicate in another matters paragraph that the predecessor auditor expressed an unmodified opinion. Yeah, if it was qualified, we give the reason for the qualification, whatever, right? But we have to contain certain elements in the other matters paragraph. Even if it was a public company, then it would be explanatory paragraph, okay? Now, you take a look, and then they talk about D that some of us picked. Obtain a letter of representation from the predecessor auditor concerning any matters that might affect the successor's opinion. The predecessor is going to say to me, hello, you were here auditing this year. Why do I have to give you a letter? You should be in position to have done the work that would be necessary to give you kind of any concerns about the previous year's financial statements. If you're scary about them, redo the audit from the previous year, but don't expect me to give you assurances. I'm not even there anymore. The letter that comes, and probably why some of you, got a little attracted to D there, is that there is a letter, but the letter goes from what? From the successor to the predecessor, indicating that I'm not aware, if I was the successor, of any problem with the financial statements, because I have 365 days, whatever, of hindsight now that might unveil some information to me about your report. You're on the outside looking in. You're not going to be giving any assurances. Okay. Okay, good. So I think what maybe, might have confused you a little bit on that one is the fact that there is an exchange of letters. And, the other thing that probably should have tipped you off that D was wrong. There's an exchange of letters when the report is presented. This report was not presented, so that would be even more another reason why D is not correct. But even if it said it was presented, D would still be wrong. The letter goes from the successor to the predecessor, not the other. Okay, good. Now let's go ahead and let's take a look at reporting on audits of group financial statements. Okay, and what I want to do is first kind of give you a little quick, picture down here that'll help define some of these terms up here. Okay, so let's say you have company A and company B, and these two companies are under the same management. What are you going to want to do from an accounting standpoint?
Consolidate them?
Good. I'm going to want to consolidate. So what I'll do is I'll take, doing the appropriate eliminating entries and whatnot, I'll create a set of consolidated statements that are company A and company B combined, right? Okay, good. Well, all we're going to do here is put some words on this sort of relationship that maybe you haven't seen before. Okay, so we have what? We have the financial statements, and we call these the group financial statements. We call the individual financial statements of these two entities the components of the group. Okay. Now, let's say I'm the auditor of the consolidated. Well, they're going to call me the group auditor. That's this group. They're going to call me the group auditor. Do I have to go and audit company A and company B? No. There could be other auditors that will be what? Will be component auditors. Now, let me give you an example. And you may say to yourself, well, why don't they just call it consolidated? Because it's not necessarily consolidated. It just might be a group of entities that are being reported together. So they don't want to use the words consolidated. So they call it group. Example, when the Government Accountability Office does an audit of the consolidated financial statements of the federal government, there are 32 agencies that make up that consolidation. Okay. My former office, the GAO, only audits the Internal Revenue Service and the Bureau of Public Debt directly. Those are the only two agencies of the 32 agencies that GAO audits directly. The rest of those agencies are audited by component auditors. Now, what the GAO does is they take the work that is done by those component auditors, and they use that as the basis then, or along with their own direct work, as the basis for, and it ends up being a disclaimer of an opinion, but assuming all those opinions were clean and whatnot, then it could be the basis for the actually, I'd say, unmodified or maybe qualified opinion. Right now, it's a disclaimer because of the problems with those other pieces. Problems with the components can bubble up into problem with the group. Okay. Now, that's just to give you a visual. We have what? We have the group engagement partner. The group engagement partner does what? Sits there and leads the group engagement team. Okay. And they will be the auditors that are responsible for what? The group financial statements. And then we have what? That's all this down here, right? And then we have the component and the component auditors. That's these people that are responsible for these components. Okay. Now you come over and you take a look, now that we understand some of the terminology, and let's understand, let's see what the group engagement team must understand about the component auditors, okay? And let's flashcard this. One, we need to understand whether they're independent, their professional competence, the extent to which the group engagement team will be involved with the work of the component auditor. What happens? Under some circumstances, we will be directing the work of those component auditors. We will say, do this, do that, do this, do that. We want you to do these procedures of the components, etc. In other cases, we will simply take their report. Okay, and it depends on how we're going to, what level of responsibility we're going to assume. Whether the group engagement team will be able to get information needed, and whether the component auditor operates in some sort of regulatory environment. You can flashcard those as well, okay? Now, come over in determining whether to make reference. So what's gonna happen? I'm gonna write my opinion on the group financial statements. I may not mention the component auditors even though they were involved. They give me that option. In the case of the GAO and the consolidated financial statements of the federal government, GAO made the decision that they were not going to mention the component auditors. And it sounds as though GAO takes the entire, well, they do take the entire responsibility for the consolidated financial statements, even though there were other auditors involved. When you read the report, you don't necessarily know about those other auditors, okay? So The auditor should understand each component and determine whether or not to make reference. The decision is made individually for each component auditor. Okay. Now, when the group engagement team relies on the component auditor to perform a portion of the audit, the group engagement team has two alternatives: make no reference, or to make reference. Okay. And let's just look at option one, make no reference. And this is, I mentioned, what the GAO does. When the group partner decides to assume responsibility for the work of the component auditor, that means no reference is going to be made, because it may misinterpret the degree of responsibility being assumed, so we don't make any reference to them. When the group auditor is assuming responsibility for the work of the component auditor, the group team should determine the type of work to be performed on the financial statements information of the components. In other words, what? Direct, supervise activities of component auditors. You treat them like your staff, essentially. Okay. Now that doesn't mean that you're going to be writing them evaluations and whatnot, but you're going to direct their activities, because you're not going to mention them. You're not going to make any reference to them in your audit report. And so you want to make sure that they are doing the work that they need to do there. Okay. Now, what happens? The level of your involvement. Okay. And if you have a significant component that is individually significant, the group are likely to include significant risk of material misstatement, will be looked at by the group auditor. Okay. So significance due to individual financial significance. A component auditor that is significantly due to individual financial statements should be audited by a component, not a component auditor. A component that is significant should be audited by the group engagement team or the component auditor. Okay. Now, when we say due to individual financial significance, we're talking about what? Pure materiality. Okay. Go back to this example that I've given you, the GAO. GAO audits, well, first of all, it's written in legislation that GAO will audit the IRS and the Bureau of Public Debt directly. It's written in the Chief Financial Officer legislation of 1990. But even if that was put in there just to make sure for sure everyone understood what was going to happen, because the reason it was written in there is because GAO was named as the auditor of the consolidated financial statements. And what this is saying is, look, really the group auditor should be taking a good look at those significant components, and IRS is the heavy hitter on the income statement of the federal government, and what the public debt is the big item on the balance sheet. Okay, so for those reasons, GAO audits those directly, and even if they didn't, there would have to be a fair amount of involvement from a component auditor for those pieces. For example, DOD isn't audited by GAO, but there is a group auditor involved in the group and involved in the component audit, I should say, for DOD, component auditors being there. I think it's KPMG, it was anyway before. Significance due to significant risk of material misstatements. So now we're looking at risk. So you may have an entity that maybe isn't as material, but there's some risk of material misstatement associated with that. And if it is significant because of risk, then again, either the group engagement team will do it, or there will have to be a component auditor that will perform an audit of that information. Okay. So risk, there's going to be what? There will be an audit if there is what? Significance due to individual significance or due to risk. So flashcard that. There must be an audit. And then we will take what? We will take the, we will take that audit information for our opinion on the group financial statements, and we're making no reference. Now, if there are components that are not significant, then we say we will perform analytical procedures. The group auditors will do that. In other words, we're not going to do a full-blown audit of those entities that are not significant either because of risk or because of materiality. Okay, now that's all under option 1. Under option 2, now we will make reference to the other auditors. So what are we going to do? We're going to take their reports and we're just going to call out what amount of work they did in our report on the group audit financial statements. Okay, now we say when making reference to the component auditor, the group statement should clearly indicate in the opinion section if we're talking about a non-issuer, or for an issuer, it's in the both the opinion and the basis for opinion sections. Okay, and now we're dividing the responsibility. And in there, flashcard where it would be presented and what we will say that we have not audited. The component was not audited. The component was not audited by the group auditor, but was audited by the component auditor. The magnitude of the portion, we'll literally call out a percent. Okay. So flashcard, those couple of things. There's other things that they ask for there, but I don't think we need to kill ourselves with a flashcard with every possible thing that needs to be included in there, because those are the big ones. Okay. Now, you come over and you take a look at what if there is a modified opinion by the component auditor. Okay, an opinion, if the component auditor is modified, or they includes an emphasis of matter, the group auditor should determine the effect on the auditor's group financial statement report. Flashcard that, but as I've mentioned a little bit last time, a little bit today, because the Department of Defense financial statements get disclaimed on, that is part of the reason. There are other reasons, but that's part of the reason why the GAO disclaims on the consolidated. So something that's happening at the group level could absolutely affect something that's happening at the component level, could absolutely affect something that happens in the group opinion. Okay. Now we give you an example of when we will make reference. We don't give you an example of what it would look like when we don't make reference, because it's exactly how you memorize. But here, for a non-public company, we mention in the opinion paragraph, and we simply call out what portion they audited. Okay, the rest of the report is exactly as you memorized. Okay, now when you come over to an issuer, remember we said it affects both the opinion paragraph, and again, we call out the percentage in the opinion paragraph that they audited, et cetera, the component auditors, and then we said what? In the basis for opinion, we say we believe that our audit, just like we did in the memorized report, and the reports of the other auditors, because we're just simply taking their reports and relying on their reports accordingly. Question? Okay, good. Let's go ahead and let's take a look at this next one then. Okay, we're a little over 2 minutes, guys. Go ahead and start to wrap this one up. Okay, good. Looks like most of us had a chance to try this one. Okay, we did okay on this one. I mean, it's 71%. We had a couple folks that wanted A or B. I would have thought we should have been really close to 100% on this. Okay, now you come over and you take a look and they tell us that we decide not to refer to the component auditor. If we don't refer to the component auditor, do we mention them at all in the report?
No.
If you don't refer, you don't mention them. So just with that as an understanding, would we add an emphasis of matter paragraph? No, we don't mention them. You just write the standard report if you don't mention them. Okay, assuming it was unmodified, you write the standard report. Unqualified, you write the standard report. You don't mention them. Further, if a subsidiary is not material, will we even bother to consolidate it? You can leave it out and it won't make any difference to the decision maker. But A is simply wrong because we said we're not going to refer. So does someone want to say what they were thinking with A? Okay, item B.
Yeah, I wanted to say that I kind of didn't understand the question because it says, let's see. Okay, so it says a group, hold on a second. So it refers to not mentioning that, but then if you choose A, let's see, hold on a second. Yeah, I think I just didn't interpret the question correctly. The way that it was worded, it's almost like you can't tell whether that person's like an independent auditor as in somebody else who was just doing something there, or they were actually part of the audit group that's doing this. I mean, that's kind of what I got out of it. Was it, you know, and then also too, it's like, if you're deciding, I mean, wouldn't you decide beforehand who's going to work on what if they were a part of that group? I mean, why would that be to me, that doesn't make any sense. Why would you be determining now what they would be working on if they don't refer to them and the report's already done? That was the other problem I had with it, which probably makes no sense to anyone but me, but it just seems sort of weird to me. Like I couldn't understand what they were.
Okay. The decision to refer or not refer is made at the beginning of the audit, not the end. Because we treat those two situations differently. So we can't decide at the end not to refer to them and then go back and do what we should have done in a situation where we're not referring. I mean,
that makes sense.
referring. So you have to do that at the beginning. And you go through and you're directing their efforts to make sure you're getting the information you need for your report, which may be coming 2-3 months down the line, right? Okay, so that's made
makes sense.
That's made at the beginning, and you direct their efforts. I see what you're saying about not referring to the other auditors. You know, but choice A is talking about at an explanatory paragraph that's talking about a subsidiary that's not material. And that's, again, we don't clutter up our audit reports with things that are not material. So that
makes
not
sense.
material part of it. But also you have to kind of read the frame of the question, which is kind of indicating how would you alter the report for this other auditor, for this component auditor? And if you don't refer, there's no discussion. Okay.
Good point. Yeah.
And then finally, we had a listing of reasons to add the emphasis of matter paragraph, and this was not one of them. Okay, emphasis of matter is something that's disclosed in the entity's financial statements, right? For something that's not disclosed, because they don't have to disclose who audited what pieces, that would be potentially in other matters, but it's not in other matters. This one is what carved off that what there were other auditors, and we put it under what? We put it under the opinion paragraph that calls out that there were these, let me double check that. What is other matters? Was it listed as a reason for other matters? No, I can't remember. Hang on one second, we could look that up. Other matters. Yeah, it's not even called out as in other matters for component auditors. Okay, so emphasis of matter is when something disclosed and it's not even in other matters.
Okay, wrong for many reasons. That works.
Yeah.
Thank you. At least
Yeah.
I can learn that way from the.
Well, yeah, no, I mean,
getting the
that's
failure on.
because I kind of said, well, it says no reference, so how could it affect the report? But then when I read choice A more carefully, it was a little bit weasel worded that, well, they're not really talking about the component auditors there, but there's no reason for an emphasis of matter for something that's not material. And even if we were going to talk about something related to the component auditor, it's not in an emphasis of matter. It's not even in another matters paragraph. And then you read further on B, document engagement letter that the group auditor assumes no responsibility for the component auditor's work and opinion. It's exactly the opposite. If I don't refer, I do assume their responsibility. And that sounds like something like Trump would say, sorry. Even though I'm not going to refer, which means I'm not responsible, I'm not responsible. We're responsible. Sorry, guys. C, obtain written permission from the component auditor to omit reference in the group auditor's report. No such requirement. I don't think anybody picks C. D, if I'm not going to make reference, what do? I have to direct their work. I determine the type of work because I need the information that I need if I'm going to take responsibility, right? By not referring. Okay. Okay, good. But I think you're getting a feeling, guys, with this question, some of the others we've looked at tonight, the difficulty of the auditing exam, which is the way they are genius at making the right answer sound wrong and the wrong answer sound right. So that's why I take that approach. Get them flashcards down. Get those flashcards in there. Drill it into your head. These are the requirements. And after a while, then you start to look at these other ones and you're like, who are they trying to kid on these? Then you start building what? Speed on top of that understanding, because now you've sharpened your understanding of these as you go through and you start going through the final review. I don't think they can touch you on the auditing exam. Okay. Okay, good. The material itself is not that hard. It's just a matter of getting good at, you know, sort of focusing yourself on how you look at these questions. Okay, good. Let's take a look then at our next module now, which is going to be subsequent events. Just let me get myself caught up here and turn back a couple pages. Subsequent events. Now, what happens? I have as the date of the financial statements in many, many cases, right? December 31st, 2022. The issuance of those financial statements, okay, will come sometime after. We don't just issue them on the last day of the year. If you're an SEC, if you're a public company, SEC has laid out certain timeframes. The bigger you are, the quicker you have to issue them, right? Okay. So there's a lag between the date of the financial statements and what our completion of our audit to where we will date our audit report, which will probably be in January, February sometime. And then there can even be a delay between the date of our audit report and when those statements are finally issued. Well, that period from the date of the financial statements to the date of the auditor report is called the subsequent period, okay? And the auditor needs to remain vigilant for things that that should be included in the financial statements that might happen during that period, or maybe things that were already existing at 12/31 to make sure that they're including the financial statements as more information comes to light. So when we look at those events, subsequent events, we can break them into two types: those that should be recognized and those that do not have to be recognized in the financial statements. Okay, so there's recognized and there's something called non-recognized subsequent events, but I want you to put down here, but disclosed. Recognized means booked. By booked, I mean what? Debit, credit. Okay. Non-recognized means what? They're not booked, but they're disclosed, so there'll be somewhat footnote around those. Okay. Now let's take a look at the two types and understand what the nature of them are. Okay, and they actually give us some examples down here too. Subsequent events that provide additional information about conditions that existed at the balance sheet date. Entities must recognize the effect of all subsequent events in the financial statements. Okay, so you take a look. Example of recognized events: settlement of a litigation. Let's say there's a lawsuit and I am sued, and the date of the lawsuit is December 31st, just to make it the last day of the year. And what happens? I settle the lawsuit, and I settle the lawsuit on January 31st, but the financial statements aren't going to be issued until February 28th. If I settle that, then I would have to, in my December 31st financial statements, debit a liability and debit a loss. Come on, John. You know, I've only been looking at accounting for close to, 40 years now. I think I'd have my debits and credits straight. I am to debit the loss, and I am to do what? Credit a liability for that. I booked that in the financial statements. Why? Because the lawsuit existed at December 31st. With me so far? Okay. Now, loss on an uncollectible receivable. What happens here? The effect of the bankruptcy may happen after the balance sheet date, but before the financial statements are issued, and it should be recognized when determining the amount of uncollectible receivable. In other words, you're saying, well, wait a minute. We find out that a client files for bankruptcy in January. Why do we have to book a loss on that in our December 31st financial statements? Well, the standards look at that and they say, no one goes bankrupt overnight. The events that led to that bankruptcy that was filed in January were already well into place in December. So if that's the case, I would do what? I would sit there and I would want to write off that receivable. So I would debit accounts receivable. I would credit the allowance. Boy, I'm having trouble with my debits and credits today. I would debit the allowance to write that off. And I would credit the account receivable, wouldn't I? I'm literally going to book that. Even though I didn't find out the bankruptcy didn't get filed until January, I'm going to book that. Now, when I debit the allowance, does the allowance balance go up or down?
It should go down.
No, it goes down. When I set up the allowance, I debit bad debt expense and I credit the allowance, right? When I write it off, I debit the allowance and I credit the accounts receivable, thus reducing the balance in the allowance, right? Now, if I reduce the amount in the allowance, there's potential that I may look and say, you know, now I don't have enough in the allowance. So this action right here, if say this was done, we'll say in June of 2022, this gets done right 12/31, say 2022. Okay, and then because the amount of the allowance has gone down at 12/31/2022, I may also decide to what?
Debit bad debt.
Debit bad debt expense for a little more, right? And credit the allowance, because now I'm saying, well, now that I had to write that one off, I don't feel I have enough in the allowance. So the point being here, guys, in these auditing exam is going to walk you through those set of journal entries. Require those set of journal entries from me. The point is it's booked, and I'm just showing you the ramifications, and it's a tricky point on the exam because what happens? The exam, they're going to tell you that they filed bankruptcy after the year end, and you're going to start to feel, well, that must be a non-recognized. But if it's a bankruptcy, it is not. It is recognized. Okay. So make sure you flashcard that recognized are actually booked. And that includes a loss on uncollectible receivable, even if the bankruptcy filing happens after the balance sheet date. That's a little tricky point, okay? Now you come over, and if it's non-recognized subsequent events and subsequent events that provide information about conditions that occurred after the balance sheet date and did not exist on the balance sheet date. For example, good example is loss of a plant or inventory by fire or natural disaster. If the plant burns down January 15th, well, at December 31st, it was there. So I would still include it on the balance sheet. And then I'd say, that factory building that's showing up on the balance sheet, well, guess what? It ain't there anymore. But I'd still leave it as an asset. I'd be presenting it on the balance sheet as though it had future economic benefit, even though by the time my users are picking up my financial statements, it doesn't have economic benefit because it was there at December 31st. Okay, now we come over and flashcard that I'll have you flashcard it somewhere else because they don't say it up there, but they do say it later, and I'll show you that it still gets disclosed. Okay. Now, let's take a look at subsequent event disclosures, okay? And all subsequent events would be having some sort of disclosure around them, okay? But the thing that I want you to definitely flashcard is that non-recognized subsequent events need to be disclosed, and recognized subsequent events have to be have to be booked, and there's disclosure. So not only does it affect the financial statements, it also affects the footnotes. And I'm pointing that out because you'll see a CPA exam question will say, recognized subsequent event, it should be recognized but not disclosed. And you think, oh, okay, that's the answer. No, recognized and disclosed. Okay, good. Now, we have this problem because the date of our audit report is January. The date of our audit report is, say, February 28th. The date of the financial statements is what? December 31st. How do we make sure we're catching all those things that weren't there December 31st, but maybe were there by January 15th, et cetera, whatever date I said, February 28th, that need to be disclosed, whatever, okay? So that period, the period between the date of the financial statements and date of audit report, is called the subsequent period. During this period, the auditor is actively responsible to investigate certain subsequent events. Okay. And so during this period, the auditor should obtain an understanding of the procedures management has established and perform the additional procedures. Okay, so flashcard that we understand what management does, and we do a prime review. Post balance sheet date transactions, look at transactions that happen in January, February. You start seeing insurance recoveries coming in. Insurance check comes in. Why did you get a check from Allstate? Oh, well, plant blew down, whatever, right? A representation letter. Again, the management representation letter comes at the end of the engagement. And in there, we ask them to give us information about things that are hard to audit. Subsequent event is a hard thing to audit because we're looking at the financial statements. They're set at a certain date. Meanwhile, the world refuses to stop turning before we can issue our report. Well, that's going to have us kind of worried. So we put down in the representation letter, we asked management to sign off that they've told us about all these kinds of things. We will make inquiries. Okay, we'll talk to different inquiries about different things, sales or acquisitions of assets, events relevant to the recoverability of assets, etc. Okay, make inquiries. Look at the minutes of stockholders meetings. Minutes of stockholders meetings and whatnot, directors and whatnot. If there's a lawsuit, you can be rest assured that that's going to come up at a director's meeting. And I saw some minutes that I was looking at where they kept talking about the case. Sometimes they put it kind of funny. I'm like, what case are we talking about here? And it turns out that one of the employees was suing the credit union I was looking at because there had been some inappropriate involvement between a board member and an employee. And so, sometimes you find out about those kinds of things, okay, by reading the minutes. And then if the latest interim financial statements, sometimes those start to get prepared before you issue the year-end statements, then, maybe the first quarter, then you might see some things that are disclosed over there that also should be disclosed in the year-end. Okay, flashcard. The procedures that the auditor should do, as well as understanding what management's process is. Okay. Now you come over and you take a look at auditor's responsibility after the date of the original report. And the auditor has no active responsibility to make further procedures subsequent to the event as described in the below chart. Let's just look at that real quick. And go ahead and flashcard these. I don't think the examiners will ask you about this, but it has to do with basically a company is getting ready to, go public and whatnot. And there's going to be a delay between the date that the auditor's report is dated and the day that the, actual filing will happen. And so they go ahead and they extend that period a little bit. I think that's a little granular for the exam, but do go ahead and do a flashcard on that, okay? Now, that's the general case. No active responsibility except for these sort of minute, granular exceptions. However, we say that if the auditor becomes aware of information related to subsequent event before the report release date, the auditor should consider whether it's necessary to adjust the financial statements or related disclosures. So you don't have to actively look for those things after the original date of the auditor's report. But if you become aware of something, then you may want to go ahead and extend procedures beyond the audit report date for the situations that are identified here below. And then if you become aware of something, you don't have to do those prime procedures, but if you become aware of something, then yes, you do need to consider whether you require financial statement revision, adjustment, or require some disclosure. Okay. Now, let's say you have already issued the report. So now the report's on the street. And you find out that there's something that should have been disclosed adjusted in the financial statements. They're already on the street. Your reports out there, the financial statements are on the street, and you find out there's something that should have been disclosed, should have been adjusted in the financial statements. How do you feel at that point?
Bad.
That's not good. That's a bad thing, isn't it? So what are you going to do?
Lawyer up.
Huh? Lawyer up? But you want management to do something about it, don't you? Okay. So let's just take a look at this. If information that materially affects the report and other person's reliance, okay, after issuance of the report, the auditor should advise the client to immediately disclose the information and its impact on the statements. This may be accomplished by, okay, so flashcard that whole requirement, advising the client to issue revised statement, advise the client to make necessary disclosures. If the effect on the financial statements cannot be determined on a timely basis, provide notification to, and the auditor's report should be relied upon. If the effect of on a timely basis, provide notification of financial statements, auditor should not be relied upon. And when we say provide notification, that could be what, taking out an ad in the Wall Street Journal or something, whatever it is you got to do to make sure people are aware of this, right? And the client should be advised to discuss this with the SEC stock exchanges. Okay, now what happens? Let's say you have this problem, and I just want to come over, and the client says, here, I'm not doing any of that. What should you do? Okay, flashcard, the refusal by the client to do the things that we asked them to, notify those using, revise the financial statements, we will first notify each member of the board of directors, okay, of such refusal. Now, what that is a prayer. That's a prayer that the corporate governance structure will work, that the board of directors will do their job and get in there and tell management, you do the things that the auditor has asked you to do, okay? Now, in the event that that doesn't happen, okay, then we're going to start to take additional steps, which would be notifying the client that we are no longer, our report is no longer to be associated with the financial statements, notify regulatory agencies, notify persons known to be relying on the financial statements, okay? So you would have an expectation that the client would follow the procedures we just talked about. If they refuse, then you have to do these things, okay? Now, let's say though, the reason I've gone in a little different order here, let's say that the client says, oh, okay, that needs to be disclosed. You're right. We're going to disclose it. Why don't you come and look to see that you're satisfied with the disclosure, because we haven't issued the statements yet, or you're going to reissue the statements with, and so why don't you just erase the original date of your report and change it to this new date or the date of the reissuance. If you did that, you would take responsibility for anything else that might have happened between whenever you had completed your audit report previously and the new date that you put down. So what the auditor would do in that situation to protect themselves, to limit their responsibility to just the disclosure of that discovered fact, is dual date the report. You would have two dates on the report, okay? So the auditor may dual date the report to limit the responsibility to just the now newly disclosed information. And they give us an example of that dual dating where you say, hey, the date of my report is January 21st, except for footnote 42, which talks about this thing that should have been disclosed before that was not, whatever the date is, whatever that date, in this example, February 3rd. Okay. All right, so you want them to do that stuff that we saw on the previous page. If they follow those procedures, you're probably gonna want to dual date for whatever it is they revised the statements to include. If they don't follow all that, then we got to start going to the board of directors and continuing the rest of that stuff. Okay, all right, good. Let's come over and let's take a look at this question. Oh, sorry, guys. Okay, guys, we're up on about 2 minutes, so go ahead and make your choice. Looks like most of us have had a chance, so I'm going to go ahead and end that and share the results. And okay, pretty good. Most of us got it right. The answer here is A, but let's go ahead in the time we have left remaining and take a look at this one. And so we can see that on August 13th, the CPA obtained sufficient appropriate audit evidence with respect to field work on the engagement to audit financial statements for the year ended June 30th. They're indicating that the day of the report was probably going to be August 13th. On August 27th, an event came to the CPA's attention that should be disclosed in the notes of the financial statements. The event was properly disclosed by the entity, but the CPA decided not to dual date the auditor's report and dated the report August 27th. Under these circumstances, the auditor is taking responsibility for what? For all subsequent events that occurred through December 27th. Okay, they didn't dual date. So it's not just this one event that they had attention to. They are now taking responsibility for what? For everything that would have happened from December, well, whatever the year end was here, June 30th to the August 27th date. Now, if they dual dated it, okay, then what? Then B would have been the right answer. It would have taken them to only the specific subsequent event. They had two dates, August 13th and 27th. Then B would have been correct. All subsequent events that occurred through August 13th and the specific event is what I just described. B, only the specific subsequent event disclosed by the entity. No, you have responsibility for any subsequent event for whatever the date of the report is. C is what I had said for B. If they had dual dated it, then they would have only had responsibility for that through the 13th, and the specific subsequent event disclosed by the entity would have been for the 27th. Look, guys, sometimes I have trouble explaining the wrong answers. They're just nonsense. D, only the subsequent event that occurred through August 13th. No, because the date of the report is August 27th. I'm not doing a good job describing why B, C, and D are not the right answer, and I realize that because they're just so out of it. I don't know what to say about them. Okay, only A is clearly the correct answer. Okay. Question. Okay, guys, that's enough for tonight. I can't finish module 10 in the couple minutes we have left, so I'm not going to try to do that. It goes this way. We will often not quite be on schedule. We'll just keep chasing that so that we can get through the material as necessary as we go along in the course. So we will pick up with chapter 1, module 10. We'll complete that. We'll definitely complete chapter 1 next time, and we'll start chapter 2. Okay, any questions? All right, guys, I will see you next Thursday. Get through those modules. Okay, I'm going to be checking on that, and we'll see you soon. All right, have a good rest of the evening.
All right, you too. Thank you.
Have a good night.
Thank you. Have a good night.
Bye-bye.
Thank you. Bye.
Bye.